everyone. Welcome back. My name is Diane Donnelly, and I am the president of the Donnelly Group of Keller Williams Flagship of Maryland. This is our third in a series in Facts Over Fear, dedicated to help people out during the critical time of uncertainty. Jobs have been lost, unemployment skyrocketed, businesses are closed, schools are closed, people are living in fear. And when there's fear, there can be emotional decisions being made, which can be dangerous. I want to get the right information in the hands of people who are searching for answers. So today we are going to be talking with David Ratty, who is the branch manager at Envoy Mortgage here in Annapolis. And we're going to talk about the mortgage industry and drilling down specifically on forbearance. It's a hot topic and one that really needs to be deciphered for us. We want to know what the pros are, what the cons are, and some alternatives to foreclosures. So David, if you would say hello and just fill in the blanks, tell us a little bit about you.
Sure. My name is David Ratty. I am with Envoy Mortgage. I've been in the mortgage business for 30 years. I don't know it all, but I've seen enough we've seen similar type of things in 9/11, and we had an economic crisis in 2007. So we saw similar things in the mortgage industry, but nothing this quick.
That's the difference, David, isn't it? Is how quickly this came down. It came out of the blue. There was nothing to prepare for.
Yeah.
We were floating along nicely with a spring market that was robust, more robust than we've seen in years, and all of a sudden comes to almost a screeching halt. So that's really what the difference is. And what's interesting, David, you and I have been doing real estate or mortgage banking for a very long time, and this is our 12th transition for changing markets, our 12th one. I'll give you a couple of examples. And I have gloves on today because I'm in a public space. So I just wanted to point that out. I don't always wear gloves. But 2001, we had anthrax. We had, as the years go on, we had West Nile. We had Maryland sniper, SARS, bird flu. 2008, the financial collapse. We had swine flu. We had the fear of the nuclear war in North Korea in 2013. Ebola in 2014. We had ISIS. We had the Zika virus. We have the 2020 coronavirus now. So all of these things made us pivot and change, and some of them were worse than others. But what all of these have in common is it creates a fear. It creates an environment of uncertainty, and it creates a paralysis, if you will. So David, knowing all of that, I wanted to talk about a timeline here, which is interesting. So November 17th, everything was wonderful. We were getting ready for the holidays. We were having Thanksgiving. We were preparing for Passover or Hanukkah rather, Christmas. We were just getting ready.
Mm-hmm.
January 1st, China announces they had, or November 17th, China had its first case of coronavirus. January 1st of this year, China announced the cluster that they saw. People started to get concerned. January 19th, Washington State, United States, we had our first case. March 5th, first 3 cases in Maryland. March 16th, restaurants started to close. It was Trisha Harold's birthday. March 28th, Anne Arundel County had its first death. March 30th, we had our Maryland stay-at-home order. Life changed for us. Life changed. Tell us about your world. What changed in the mortgage world?
Well, first, some people may not realize, but mortgage lending, real estate, and title are considered essential services. It's your shelter. So we are open. We do have most of our employees telecommuting. Fortunately, the technology is such that they're very easily able to do that. But to answer your question, in the mortgage business, we started out February on fire, like literally on fire. Rates plummeted. Everybody started looking at houses to buy homes, to refinance their current home if they're in a home. I mean, we have some people that are closing today, which means they locked in February in the twos, like mid twos. So our industry actually originated about 4 times the amount of loans that we had done the month prior. 4 times. That was rolling along fine until all of this panic hit. And this panic has caused massive disruption.
Was that business that you were doing, was that mostly refinance business or mostly purchase business or a combination of the two?
It was a combination of the two, but the refinances hit hard and fast when the rates dropped that low. And most lenders still have those in the pipeline. They're just closing them now. So they will close through April and May. The lenders' bigger concerns are what's going to close in June and July.
Yeah.
Because those are the people writing contracts now. But what we saw, to answer your question, I mean, the disruption in the mortgage business was significant. First of all, nobody was prepared for this. Unemployment was rolling along at 3%, the best ever. And I believe on Friday it went to 13%. I mean, that's a really dramatic change in employment and people's ability to pay their bills. So the mortgage business is predicated on people being able to pay their bills. So a lot has changed from a lender's perspective because of the pandemic and people being furloughed and the unemployment rate themselves. So to answer your question, I guess the past 6 weeks, have you ever been to King's Dominion?
Yes.
Yeah. So the past 6 weeks has been sort of like the Rebel Yell, that roller coaster. We have seen some dramatic shifts in the business. I think a lot of people aren't even aware of what has happened in the mortgage business that has been so dramatic. We had an entire segment of our industry just evaporate overnight. We call it alternative.
Can I stop you for a second, David?
Yes.
So looking at this from an outsider, okay, so there's a lot of people that are going to watch this and they don't have the experience of real estate or mortgage banking. They're looking at it and they say, oh my gosh, everything must be great. The interest rates are fantastic. I'm going to go ahead and do this. I'm going to take care of this. And what is the psychology of the investors? So all of this influx of business comes to you, which is, you know, when there's that much business, it seems like it's a great thing. But what people didn't understand on the outside was the havoc and the chaos that it was creating, because the amount of refinances that came through when it was under 3%, or, you know, maybe it was 2.9 or 2.75, created such a backlog that people were getting scared. The investors were getting scared to hold on to that money, right? So can you walk us through the psychology of the end investor, or Fannie Mae, Freddie Mac, or whoever the secondary market is?
Sure, absolutely. And it's really important to understand it, but I tend to get too technical sometimes. So just rein me in.
I will.
The CARES Act had a lot of provisions in there to protect the consumer. It had no provisions in there to protect the lender, or what I'm going to call the servicer, the lender that services your mortgage. What people may not realize is that the servicer receives your mortgage payment, but they don't own your loan. They're not the end investor on the loan. They have to make a payment to the end investor, whether you make a payment or not. So we hear a lot of talk about forbearance, and servicers are looking at the provisions in this act and saying to themselves, wait a minute, if we have 1 out of 3 people that may lose their jobs, that means we could have 1 out of 3 households not able to make a house payment. Why would I service or want to have these mortgages if a third of them, or up to a third of them, may not be sending in payments, yet I still have to send a payment to the investor, and I have to hire the additional staff to process these forbearance claims? So that's what has happened. The value of these mortgages has plummeted because the servicers don't have an appetite for that kind of risk.
So risk went up investors got less interested. When the investors get less interested, things have to change.
Yeah.
So some of the mortgage programs have changed drastically. So we're looking at, if you can touch on jumbos, explain what a jumbo is.
Sure.
And the FHA and the VA, what rules have changed and what is the impact to our industry, to the real estate side?
Sure. Now, in the mortgage business, I think it's fair to say, for the most part, most lenders have pretty similar guidelines and requirements. This volatility that has happened in the financial markets has widened that spread. There is differences lender to lender. So that being said, some of the changes that have come into place really revolve around the risk element. So the investors and the loan servicers have no appetite for any additional risk whatsoever. So the entire segment of the industry that has just evaporated overnight is what we call alternative financing. This is where we would verify income through bank statements or unusual properties or recent credit events. Maybe you had a bankruptcy 2 years ago instead of 7 years ago, or a year ago. Those programs just evaporated overnight. The other thing that has happened when you talk about jumbo loans are loan amounts in Anne Arundel County above $520,950. Let's call it 521 as a loan amount, not a sales price,
Not a sales
as a
price
loan
number.
amount.
Mm-hmm.
When the loan amount goes over 521,000, it's no longer eligible for Fannie Mae or Freddie Mac or FHA financing, and it becomes jumbo financing. In essence, it's balance sheet lending. So investment houses or banks are lending depositors' monies. For most mortgages, that's not the case. These are, for most mortgages, they're mortgage-backed securities. They're, in essence, funded by your own 401k. You buy $10,000 of Ginnie Mae mortgage-backed securities in your 401k. That's, in essence, a piece of somebody's mortgage. Mm-hmm. So not to get too far in the weeds, but when we go to 521, now we're dealing with balance sheet lending. The problem is right now, most consumers and businesses are hoarding cash. Everybody.
What does balance sheet lending mean?
That means they're lending depositors monies. So there's only a limited supply of that, theoretically. And right now, just like every household, everybody is conserving cash because we don't know how long this will last.
So there's less money to lend.
There's less money to lend. And what we've seen is a lot of jumbo investors have suspended their programs altogether.
Mm-hmm.
For
what
instance,
does that mean for us then? How do people who have homes, luxury pricing, how do they sell homes right now? What is the alternative to having jumbo or a loan amount above 520? If we can't have that, what options are there to be able to continue to buy?
It's still available, just not readily available. Okay. So that is where you'll find a large variance lender to lender. So if you are in the over $500,000, over 521,000, you may have to shop around to find it. Some of the risk profiles that used to be present and aren't anymore might be somebody with a $700,000 loan wanting to do a cash out refinance, get a new loan for $800,000 so they could have $100,000 in their hand. Those programs have pretty much been eliminated, suspended. Mm-hmm. So if you're going to refinance to reduce your payment or you're going to purchase a home, there is still jumbo money available for those purposes, but any additional risk factors, no. The lender may also want to see 6 or even 12 house payments in reserves for the jumbo side of things. I'm talking about just jumbo. The lender may want to see that you have a half a year or a year worth of reserves in the bank so that you don't go to closing and then have to file a forbearance claim.
Right. And then let's say that somebody wants to buy a house, it's jumbo. It's a luxury price range.
Yes.
What's an 80-10-10? And are they available?
So, yes, they are. An 80-10-10, or sometimes you'll hear called 80-10-10, 75-15-10. These are what we call piggyback loans. This is when you get a first mortgage and a second mortgage at the same time. So let's say the house is $750,000. The maximum loan amount for Fannie Mae is 521 in Anne Arundel County. So you would get a loan for 521 in Anne Arundel County. And then you would get a second mortgage on top of that for, let's say, $75,000. So you're able to borrow aggregate a lot more money by getting that first mortgage at 521 and then that second mortgage for, say, 75,000. So you're still putting 10% down on that expensive home, but you're doing it through two different vehicles.
And then you also don't have mortgage insurance. So we won't go into all the
Correct.
details of that, but it's suffice it to say that there are some options still available. And what's
There are.
important to know here too is I've talked to a couple of lenders, and what you said was so important that people are going to have to shop around right now. So a couple of lenders that I talked to, they would say, oh, FHA, the guidelines have changed. No one can buy a house unless it's 680. Well, that's not the case. It's lender dependent.
It is.
So I think sometimes we have to be very careful with who we're talking with, because they may want you to use them. So they say that's not available anymore when it is, but let's use this program. So it's important to know people need to shop around. All of the mortgage companies have different risk tolerances.
Yes.
And credit guidelines. So they could say, if they want to sell to the secondary market, this is what's going to be required. And then Envoy might say, but I want this, or I want that, or Bank of America could say, well, I'm not that risk tolerant, I'll do this. So it's really important to know that. And with that said, so we know that FHA, VA, jumbo loans have all taken somewhat of a hit because of the risk, unemployment, etc. So let's get to the forbearance part. So,
okay.
So now we know that there's going to be people that have been furloughed or are now unemployed that are going to have a difficulty in making a mortgage payment.
Yes.
The word forbearance comes up. What is forbearance? How does that work?
It's a great question, and it's probably a largely misunderstood term. Forbearance is not a gift, and it's not free money. I think a lot of people feel that means, hey, I can skip some mortgage payments. Forbearance is a deferment. It's a delay. So there's no gift here. There's no free money. And I think it's important to keep that in mind, because people can put themselves in a situation that they may not realize. So let's talk about what forbearance is and what the CARES Act does for forbearance. So as a current mortgage customer, you can contact your lender, and that lender can provide you with a 6-month forbearance, a 6-month delay. That 6-month delay, when that period is up, you have to keep in mind, let's say your house payment is $2,000 a month. That's $6,000 or $2,000 for 6 months. That's $12,000. So in the 7th month, you owe your house payment of $2,000 plus $12,000 that you didn't pay for the previous 6 months. That's a $14,000 bill 7 months from now. And I don't think most people realize that they could be put in that situation, and it's not a positive one. So that being said, if you don't have a choice, it is there for you. If you are able to make your house payment, you may want to think twice about filing a forbearance claim. But if you do, here's what the process that you want to follow based on the CARES Act. Number one, you want to contact your current servicer, your current lender. Explain to them your difficulties. They're going to have you apply for file a forbearance claim. And here's the important part. The proof of hardship is based on your word. It's based on an attestation. In other words, you don't have to provide, by the law, you are not required to provide any documentation to prove that you lost your job, for example. You do have to just attest to that fact. So that's how the act is written. The proof of the hardship cannot be required, or is not allowed to be required by the servicer. So if the servicer is asking for that by law, they cannot.
So this sounds like it could be a great thing for somebody that needs it and very dangerous if they don't.
Exactly. And the danger would be in 7 months, all of a sudden they would have to, you know, in our example, pay $14,000. Maybe they would ask the lender to let them pay it back over a year or work something out. But I mean, you could see how devastating that is. That's over $1,000 a month.
Yeah.
And most people couldn't afford an extra $1,000 a month after being out of work for 3, 4, 5 months.
David, are the terms of a forbearance negotiated with each mortgage company? Could it be different? Could one mortgage company say, I want everything in 6 months, and one
Yes.
say, I'm going to put everything on the back. You owe me $12,000. I'm going to put it on the back end and just start payments now.
I think the realistic answer to that is they're going to have to negotiate.
Yeah.
Because nobody's going to be able to write that check, or they wouldn't have filed for a forbearance claim to begin with.
That's exactly right.
So the other thing too that the CARES Act provides is that an additional 180 days may be extended. So now we're talking another 6 months can be extended further if the borrower is still facing hardships. So there's actually a back-to-back forbearance claims that you can apply for. So you literally could defer a year of house payments. But I think that would be absolutely devastating to most households. So it would only be something that you did because you had to do it. You didn't have a choice. The other thing to keep in mind is that the lender cannot collect any fees, penalties, or interest because of that forbearance claim.
As a result of the CARES Act.
Correct.
Okay.
That's correct.
Different than before or after this, because they can.
Absolutely.
So the Maryland Bankers Association has asked them to add that to their the act. Is that correct?
That is correct. It is part of the act now. The other thing also to keep in mind, a lot of people have been asking about this, is how does it affect my credit? Well, the CARES Act does protect the consumer that during this period, this pandemic, if you do have a forbearance or a deferment of your mortgage, the lender cannot report you delinquent on your mortgage. That's a good one.
That is another good one. Those are two very important things. So I want to do a what if scenario with you, but I also want to know what if somebody said, I'm nervous about the economy. I don't know what's going to happen. I don't know when the virus is going to be remedied, for lack of a better term. I want to keep my cash. So my $2,000, instead of paying the mortgage company, I'm going to put $2,000 into a little account, to a little kitty. I'm going to continue to do that for the 6 months, and I'm going to wait it out to see if I don't need the cash, right? So everything is lifted, everything is good. We're getting back to work. Things are getting back to a more normal state. I feel good. I'm employed, and I'm going to release that. I go to my kitty and I say, on $12,000 right now, here you go. Isn't that one strategy that might be a smart strategy, or do you suggest against that?
No, I think it could indeed be a smart strategy. It was like we were talking about a few minutes ago about everybody hoarding cash. Investors and households and everybody is hunkering down and hoarding cash. So yeah, that could definitely be a strategy. And I saw also we had a question for somebody that said, hey, if they add 3 payments to the end of my mortgage, how would that be devastating? And it wouldn't be if that's what is done. And in the end, each servicer is going to negotiate how you're going to pay back that money. Keep in mind, the servicer is paying the investor all the time. You're not paying the servicer. They're not going to be, happy about having that money, in essence, lent to you in perpetuity, forever. They're going to want to recoup some of their money as fast as possible. So ideally, if the lender does add that to the end of your term, so instead of it being a 30-year loan, it's a 30-year and 6-month loan, that would be terrific. I have a feeling you're going to be seeing servicers wanting to recoup their money a little bit more aggressively than 30 years and 6 months from now.
Well, just like we talked about in the beginning of this call, I can't imagine how upsetting something like this is being unplanned. So we talked with Christy with Embrace. I keep thinking Embrace. Christy yesterday, she was with doing the help me out, David.
Emerald.
Emerald, thank you. With Emerald Financial. And she told us yesterday that, you know, with all of the people that are coming in and the bankers having to go and try to process all of this stuff all of a sudden, all at one time, it's devastating. I can't imagine with the mortgage company, the amount of the influx of people saying, I need help. I don't know what to do. I need help. Where is this going to take us? Where do you see the mortgage side, let's say 6 months, pick a number in the future? What do you think is going to happen?
Well, that's a great question. I mean, the challenge for the servicers is large. Keep in mind, they all have displaced workforces as well. So they may not have the efficiency and synergy that they normally would have. And in addition to that, you're talking about just handling the phone calls, the inquiries.
Mm-hmm.
They would not have adequate staff. No lender would have adequate staff to handle that. They're going to have to shift resources in order to accommodate that and help the customers. And that's part of the challenge why we've seen such volatility in mortgage rates. I mean, in February, they were the lowest they've been in the history of planet Earth.
Mm-hmm.
Right? When we got into March, all of a sudden, the value of the servicing rights that the lenders pay for probably lost 50 to 75% of the value, and you saw rates go way up, relatively speaking. I mean,
right.
we're really in a blessed market,
right.
but we saw them go way up in the panic over the financial hardship that the servicer is going to experience because of this. Now, we've seen some of that balance out because we've seen some of the risk elements tightened up or eliminated with the mortgage programs. So, for example, it wasn't but a month ago, the minimum score for most lenders for FHA loans was 580. Well, today, for most lenders, it is 640. Some are 660, some are 680. The majority are probably somewhere around 640 as a minimum credit score. Lenders are also looking at reserves, how much, and they're also looking at affordability. So where a month ago, they might allow you to have a little bit more flexibility on how much debt you have. Lenders are looking at that a little bit tighter as well. They want to know if they're making a loan today that tomorrow you're not going to be in a bad position.
Well, you know, you think back to 2008, and part of the challenge was because of the alternative financing that was going on. We were in essence, I remember saying, we're borrowing from the future. The people that we are putting into homes today, because of the appreciation, you would buy today and it's worth $10,000 more the next day, it felt like. So lenders were just handing out money. And I just remember thinking, these guys, their ratios are too high to be getting a loan now, but they were getting them because the appreciation was going up, the equity was coming in board. So the lenders weren't fearful. They'll get their money back if anything happens, but then it tanked. So I think that the banks are doing the right thing now and tightening it up now and not borrowing from another future generation, and putting the brakes on that.
Yeah, I think those lessons were learned from back then. You know, you had scenarios where there was no doc loans and lenders were charging, you know, like 10%. But what's good is 10% if the payments aren't made.
Mm-hmm.
And
Right.
that's what contributed to that. So the foundationally, the lending industry is on a much more solid ground than it was in 07 and 08.
Mm-hmm.
This is temporary. This will end. We will see normalcy. The other thing to keep in mind too is very quietly, you know, we had the spike in rates when all the panic happened. Very quietly, well-qualified borrowers are getting really great rates right now.
Mm-hmm.
Very quietly. Now, really well-qualified buyers are in demand from servicers. They want the really high-quality buyers.
Who are they? What does that look like? What kind of a buyer is a well-qualified buyer?
I would say if you somebody who's buying a first home, second home, even you know FHA, that you can see them in the twos for a 30-year fixed rate mortgage. So say 720 credit score, putting 3.5% down. That's realistic for a lot of people.
Yeah.
That's fantastic. Now, when you get closer to the 640 credit score ranges, you'll find out that it's risk-based rates. So that person may end up with 4%.
And or additional points. Do they have to pay additional points if
They may indeed.
Mhm.
Yes. To
So
buy that rate down.
To buy the rate down. So how would you advise somebody to prepare, right? In every adversity, there's a silver lining. There's going to be some great opportunities out there for people to buy homes here in the short future.
There is fantastic
near
opportunities. I mean,
how do they prepare now for that, for you to lend them money? What do they need to do to start preparing?
well, number one, even more than ever, they want to sit down with a loan officer. Well, I say that figuratively. Nobody's
Right.
sitting down with anybody right now. But for example, we do video chat. They can apply online, and we do video chat. We do not do face-to-face meetings for their safety and ours. But the consult is what I'm referring to. It's more important now than ever because of all these disparities, because of the volatility in the market. The average consumer that maybe has bought one home in their life doesn't want to try to do this on their own. They want to have a consult with a loan officer so they have a full understanding and they have somebody who is guiding them through this minefield, if you will. I think that's more important than ever before, that you don't want to try. I liken it to, if two people have never been snow skiing before and they go to the mountain and one of them gets on the lift, the chairlift, and goes up to the top, and 20 minutes later makes it down to the bottom somehow, some way. The other person doesn't ask them to teach them how to ski because they've only done it one time in their life.
Mm-hmm.
So buying a house, you have a family member or somebody at work, they've bought one home in their life and they're giving advice, and all the advice is different and it's confusing and it causes anxiety. So this is the time when you definitely want to have a professional consult you and guide you as to the best path to take.
So that's prior to them finding a house. It's get qualified. Let's make sure your credit is okay, that you got the cash available, that your history is stable to be able to purchase a home, and if so, here's the price.
And it's actually no different than going to the grocery store. If you're going to the grocery store, you check to see how much money you have to go buy groceries. And when you buy a house, it's no different. You want to get the money in order before you go out and walk through somebody's home or go to purchase a home. And the biggest heartbreaker in the world is somebody goes shopping for a home or looking at homes that are $400,000, and I have to break their heart and tell them that they should be at $300,000.
Yeah.
So
Get
definitely.
up front.
Yeah, definitely.
Before I ask my last question, does anybody have any questions about foreclosure or forbearance or short sales or any alternatives to a forbearance?
I do.
Yes, ma'am.
I was wondering, are they even allowed to do a foreclosure? I know we were talking about that.
Great question. There's a moratorium on foreclosures until May 18th. I think you can pretty much count that being extended as well. It's just nobody knows how long this will last. And again, this is all temporary. There are a couple points on the forbearance I'd like everybody to keep in mind too. Number one, keep all written documentation.
Good point.
Right, take notes, keep documentation. Pay attention to your monthly mortgage statement you get each month. Remember what we said about lenders having a staff up to handle all of this volume? Mistakes are a human trait. So it is possible that mistakes could be made. So pay attention to your mortgage statement each month to make sure that the balance that's being deferred is properly being recorded. Keep an eye on your credit as well, because they should not be reporting you late. You don't want to wait 6 months and then figure that out. So keep an eye on that. And the biggest thing is that once your income is restored, contact your servicer and try to minimize how much deferment you have to deal with later.
That's a good point, David. So In keeping with that, when there's an agreement, so it sounds to me that there's going to be some negotiations made with this forbearance. Will all be in writing from about what the terms are. So if we say, okay, I'm going to do a 90-day deferment for forbearance, that should be in writing as to that was an agreement different than what is typically being offered. So anything that is different should be in writing, right? You should get that in advance.
Yeah, just to protect yourself.
Okay. And that's the same, Angie's question was about, the moratorium, and it's the same thing for the rental. You can't be evicted right now, just as we can't be foreclosed on for a mortgage. And I think, Andrea, you may have had a question as well. Did you want to put your question in the question box? I think she was talking about the time frame. So one of the things on a normal forbearance, it would say not paid as agreed or something like that on the credit report. Is there a time frame that you can purchase a home after a forbearance outside of these conditions?
Well, since the CARES Act does protect the consumer for any adverse reporting related to this, this is a totally unique circumstance where typically the answer would be different in that there would be a seasoning or a waiting period before you'd be eligible for financing. That's not going to apply here.
What is that time frame outside of this particular condition here? How long is forbearance?
That's going to vary by loan product and loan guidelines, but in this case, it's going to be zero.
Yeah.
Zero seasoning.
Okay, perfect. Anybody else have any other questions? All right. Well, David, I can't thank you enough. That was really important. There's
I have a question for you, Diane.
Oh, shoot.
Let's say somebody does get, and I just want to do real life. Let's say somebody does have a deferment, a forbearance for 6 months, and their employer doesn't open back up. What does that look like if they had to sell their home?
Well, there are a couple of things. The first one is there any equity in the home? So if there's no equity in the home, we have to do what we call a short sale. And that we're going to be talking about that next week, where you have a professional negotiator coming in next week to talk about short sales. But a short sale is simply, you need to sell your house. There is a hardship. It continued beyond the CARES Act. Everything's healthy, but unfortunately you have fallen on hard times. So you ask the bank to say, I need to short you what I'm going to pay you back. So I owe $300,000 on the mortgage, and the house is only going to sell for $280,000. I need to short you that $20,000 plus additional fees, and that is better than a foreclosure. And we have, and I know that with the economic climate that we're in, we're going to see a rise in short sales and a rise in foreclosures. That's why I want to make sure that we're talking about that now, because sometimes people get into a difficult situation and then don't talk about it. And it goes on and on and on, but there's so many answers before it gets to that point that I want to be sure that, because now we have been given the gift of knowing that this is going to happen. This unfortunate thing is going to happen. So we are going to start to prepare people in advance so that it's not where they're at the stage of the foreclosure date is in 6 days. Let's talk about that well in advance to avoid that situation. Did that answer your question, David?
Yep. And I'll tune in next week to learn more from your speaker.
Awesome. He's done a lot of short sales in the past year for us. His name is Steve Hamilton, and he has relationships with a lot of banks. So we're going to get some really good information out of that.
Awesome.
Excellent.
I had one quick question, if I may pop in, and I may have missed this, but are there any changes with the VA financing, David, that we should know about?
There are, and again, it's going to vary lender by lender. For VA, the minimum credit scores have also been impacted, just like FHA. So most lenders are going to be at 640 now for a minimum credit score for veterans.
Okay.
It was 580. And again, once the employment situation straightens itself out, we should see it go back to pre-crisis guidelines. But for now, that's going to impact a lot of veterans. And also keep in mind, there is VA jumbo financing. That market has also been impacted. So when you get above, in Anne Arundel County, 521,000 on a loan amount for veterans, it's still available, but the terms become dramatically different than under 521,000. So veterans may be paying points over 521,000.
Good to know.
Anybody else?
Nope.
All right, you guys, thank you so much. I appreciate everybody tuning in, and stay tuned. We are going to be talking to an estate planner next week. We're going to be talking to a short sale negotiator to talk about alternatives to any foreclosures. So tune in, and please share this with anybody that needs to hear this message. But otherwise, stay well. We look forward to seeing you next week, and thank you so much for your time. Appreciate it. Where
Excellent.
can they call you, David, if they need to reach you? Where should they reach out?
You can get me at the office. The phone number is 667-223-1900. I'm right here in Annapolis. I'm actually in the office today because nobody else is.
Likewise.
Yes.
David, thank you so much. We appreciate all your help.
Thank you. All right.
Take care. Bye, everyone.
Bye-bye.